what we're going to be talking about today.
Yeah, absolutely. So Nick and I wanted to, get a call together, obviously on this important day, in the global economy, I would say. Obviously with the U.S. election, hopefully coming to a conclusion this evening. Of course, time will tell over the next couple of days. But we wanted to just get together, give you some of our thoughts on what we're seeing, in global markets today. Some of the past, when we look back historically, Nick and I have done some work in looking into the way markets have reacted, on past elections with different presidencies in office, different presidents in office rather. We're going to go through that a little bit, talk about some of the themes and sectors that might benefit from a Harris win or a Trump win, and what we see moving forward from our lens. So without further ado, we appreciate you guys, joining us today. As Nick alluded to, if there's questions, feel free to toss them in the chat, and we'll cover those at the end. Anything, outside of that, also feel free to send us an email following the call, and we're happy to answer anything that might come up as you're stewing on things through this evening and into tomorrow. So thanks again for joining us, and we look forward to taking you through, some of the things we've come up with, things to take note of moving forward here.
Okay, great. Well, thank you everybody for tuning in. This is every election seems to come with a lot of stress, and what I find, it ends up, the election passes and we sort of get back to normal. And so that's what we want to that was sort of the main point of this today, is sort of, okay, let's have a look at what's happened in the past, what do we think is going to happen, and let's get into it. So this first slide shows the history of the market returns following the presidential elections. That goes back to, well, it's 1944 to 2016. One of the notable things I'll note here is, looking at George W. Bush, there was a negative 12.4% return in the Dow Jones during his presidency. But if you look, that's year 2000. Well, what happened in year 2000? We had a really expensive stock market. So I think you can just kind of, then some other notable things. Look, Obama had a great second term, stock market up 17.9%. But again, he's coming off of the great financial crisis. So that sort of gives you a little lens into the history of each president. So if you go to the next slide, this is the valuation I was speaking to. If you look at the year 2000, that huge spike. So this is the Case-Shiller adjusted price to earnings ratio on the S&P 500. So you'll notice 40 being very expensive, obviously, in hindsight. That's when the technology bubble had a lot of companies trading, whether it's a Cisco or some of the, high-flying tech stocks trading at crazy valuations, some of them 100 or 200 times earnings. And then again, if you look at, and I think this is sort of the things, some of the angst that I want to talk about, because, it depends on what rabbit hole or what Twitter feed you go down. You may read some articles that are calling for really dire things. Warren Buffett selling stock, record amounts of cash, stock markets at record valuations. So I just want to talk about how, markets have navigated through these periods in the past, and we'll get into some good examples of where you can make money even in an expensive market. So I like this one. Presidents don't control markets. This is one I found on Twitter by Ritholtz Wealth Management. So it's just, we're looking out, taking a 2,000-foot view, looking down at the markets. This goes back all the way to 1901. Presidents don't control markets. You can see, for the most part, the markets go up no matter who's in power. Again, you'll notice some notable periods, like again, that 2000 to 2009 sticks out like a sore thumb. That's when the U.S. markets basically went sideways for a decade because the valuations were so expensive. And where you could make money in that time period was Canada was actually a very good place to be. Our Canadian banks were trading at 8 times earnings. You could buy oil stocks trading at 5 to 9 times earnings, and that's where a lot of money was made and China was ramping up, so resources were in high demand. So anyway, that's one period. But again, we'll show you where you can make money in a period like that. So if we go to the next slide, so Marcus and I and our chief market strategist, he's also our economist, Dr. Jim Thorne. You may have seen him on BNN. Some of our clients have been exposed to him in real life, but he feels, and I feel, the same way that we're kind of in the similar setup to the 1990s, where we're coming out of the 1987 stock market or real estate crash. There was a stock market crash as well. What was in front of us in the 80s, the 90s? It was the internet. Where was the best place to invest? In US technology. That was the best place to be. Real estate didn't do anything for 10 years. We kind of feel like that's the setup today. Real estate's overvalued. It probably goes sideways for 5 to 10 years. What's in front of us? AI, the biggest, fastest moving technology we have ever seen. So you can really overcomplicate it, but really just want to be exposed to US and technology. And one thing I found was kind of interesting. So speaking to what will the policies be going forward? We'll get into it in the next slide, but in this slide, there's an interesting, in bullet point number 4, legislative impact. So back in the 90s, the Clinton economic policy was calling for deficit reduction. What have we been hearing in the news? If Elon teamed up with Trump, they want to create the Doge Department, the Department of Government Efficiency. Poilievre's talking the same way. They're cutting in Argentina with Javier Milei. So this is the chatter that we're hearing now. It's all about, okay, we have record GDP, debt to GDP. What are we going to do to solve this? Well, so anyway, this is Clinton did the same thing, reduced deficits. They did increase taxes, but it was offset through investment in the markets. So this sort of leads to the next. And there was a lot of deregulation. Sorry, so the deregulation was a big theme back then, just the same as this now. So yeah, next slide. So this is a good one that BMO put together. It's talking about, okay, what sectors would do well under a Democratic win and then a Republican win. There is quite a few bullet points here, but to me, the biggest ones are, so the hot topic issues are regulation, taxes, inflation. We can get into some of the nuances, but if you think about deregulation, for example, if the Republicans get in, the talk is that they like less regulation. So what does well under that theme? Well, small cap companies, they find it harder to navigate regulations. The financial industry, if we remember back in 2009, they really got handcuffed with a lot more regulation. They weren't allowed to take on risk because they basically blew up the world economy. So they were handcuffed. The thought is if it's a Republican win, there will be less regulation going forward. And then thinking about inflation, so some people were saying, well, under if Trump should get back in power, for example, this could be very inflationary because, he may slap more tariffs on China. And if you remember back in Trump's last presidency, there was inflation because the goods coming overseas were increased in value because we were having to produce locally. So solar was a good example. There's a lot of onshoring because Chinese were dumping in North America, and so solar prices went up, and there was other inflationary things that happened. We would argue this time around, a lot of those policies are already in effect. You have to currently today, you can't just dump solar into North America. You have to manufacture in North America. So these policies are already in place. So we don't think that will be as big an issue. And if this cost cutting happens and you have a reduction in government, that's actually deflationary because it's less spending. So we don't see Trump as being inflation, or not just Trump, but conservatives in general as being inflationary. Going back to the Clinton era, it's a good thing to look at. They did the same thing, and the markets did very well. Climate change is a big one. Well, okay, yeah. So we'll just go next slide. So there's 3 sort of big themes we want to talk about today. There's a lot of other ones, like there is healthcare, for example, and I might as well touch on that. So healthcare is another good example where if the Democrats get in, the thought is they want to push things through like universal healthcare to have something similar to Canada. So there may be areas to invest there. We have identified a bunch of either funds or sectors. For example, if they were to have universal health, first of all, it wouldn't happen overnight. So we've got time to see how this plays out, which is why we're not positioned there currently. We will talk about where we are positioned. But for example, there are hospital providers. They're publicly traded in the US. You could buy them. They provide care. There's, if there was more procedures being done, people are saying, well, maybe Medtronic and Stryker will do even better because there's going to be more medical procedures. So those are some areas we're watching. Like I say, we don't know what's going to happen tonight. This may drag out. To Marcus's point, I have a feeling this is going to be a drawn out, ballot count, but we'll see what happens. So thinking about financials, we haven't put any slides up, but if there was deregulation to happen, the US financials are actually very inexpensive right now. They trade around 12 times earnings. So thinking about a JP Morgan trades at 11 times forward earnings. Same with Canadian banks, are fairly inexpensive. But the thought is this wouldn't be as beneficial for Canadian banks. It'd be beneficial for US banks because if they're deregulated, the thought is that they can gobble up a lot of the regional banks. So, and they can lend more. And that also plays into, we've had a big position in KKR for years. We've been selling it recently. Clients have asked us why. We love the company, stock's making new highs, but its valuation, when we started buying KKR about 10 years ago, it was trading at 6 times forward earnings. Today it's trading at 39. And the backdrop, why the private equity did so well, is because the banks weren't allowed to take on risk. They had to sort of de-risk, and all those risk assets. So private lending, for example, is a huge part of private equity's book, went to the private equity company. So they had this huge tailwind. But if this regulation reverses and now the banks can take on more risk and we can buy them at 12 times earnings and sell, private equity companies at 39. I mean, KKR is an outlier. It's really expensive compared to, say, Apollo or Blackstone right now. But that's things we're thinking about. Okay, so into the small caps and clean energy. This is the part that sort of gets me very excited right now. This opportunity is really great. It hasn't played out. Large caps have been the place to be, and we still think they will be. We have exposure there, but there has been a rotation ever since NVIDIA hit a high in the summer where the Mag 7, so that's, Meta and Apple and all the big tech companies, they kind of gave way to small cap. People started buying small cap in the middle of the summer. If you go to the next, this slide on the left-hand side, it shows the PE ratio of that index is the cheapest it's been, basically going all the way back, 20 years. It's cheaper than it's been. So 16 times earnings. And then you look at that discount on the right-hand side. It's kind of hard to read, but it says it's basically trading at a discount where it's historically traded at a premium to large cap. And this sort of changed in 2019 where it crossed through the zero line on the right. So next slide. So back when we were talking about the Case-Shiller index trading at around 33 today, price to earnings. So I might as well give a recap on price to earnings just for those that don't know. I think half of you would have a really good idea and half may not. Price to earnings, I always like to explain it. The simplest way to think about it is the price of let's say a price of a stock is $10 and you're earning $1 per share. You're trading at 10 times the earnings. 1 divided into 10 is a 10% return on your money. So if you're trading at 30 times earnings and the company's not growing, you're actually only earning 3% per year in your money. That's when Warren Buffett famously said back in the 2000s, he thought there was going to be a lost decade and you'd only make 3% on your money if you invested in the S&P 500. And he was right that it went sideways, like we saw on that chart before with the presidents. But in that period, you could still make money in small cap, which is one area. I also talked about, the Canadian banks and the resource stocks did well. But look at this chart here. So in year 2000, the S&P 500 down 9.1%. S&P 600, which has smaller companies, up 11.8%. So the difference between those two was 20.9%. 2021, again, 18.4% outperformance. Market was negative 11.9%. 2002, negative 22%. And the S&P 600 was negative, but it was still outperformed by 7.5%. So if we go to the next slide, this clean tech, this isn't just clean tech. We want to sort of, people, you guys are going to laugh now that we're getting onto a Tesla topic, because a lot of you know I'm a big Tesla bull, but it's not just about Tesla. It's about the energy future and where money is going. There's a massive amount of money we're going to dig really deep into the topic now because it is such a huge theme. The decarbonization of the world is happening. There's been a lot of rhetoric this year. You see the headlines: nuclear, okay, clean energy is bad, EV sales are slowing. It's been a real negative year. If we showed you charts on solar stocks, a lot of them are down 50% this year as one example. But if you look at what's really happening, and here's where we're going to get into the actual facts of what's really happening on the ground. If you'll see that big blue slice in this pie, that is renewables, and it's 38% of the electricity market. $1.74 trillion in clean investment. And where did it go? So the grid is a larger part of that as well, which is the bottom left-hand side. You'll see $331 billion is spent on the grid. So that basically means building out the switches and transformers and actual power lines, as opposed to just windmills and solar and whether it's tidal systems or hydroelectric, as an example for renewable. But the point here is, if you look at nuclear, it's a tiny little slice on the top left-hand side, albeit it's growing with the talks of Microsoft building out data centers by getting power from 3 Mile or whatever, or China is building a lot of nuclear. But as we go through these slides, you're going to see, so if we go to the next slide, this is what starts to blow my mind, and it's with regards to, this is electricity generation in the world based on terawatt. Now, terawatt is 1,000 gigawatts. A gigawatt is 1,000 megawatts. You'll see later how this is a very large number and where we are today in renewables. But if you just sort of remember some of these numbers, so this is this is about 25. This chart's a little confusing, but it represents 25,000 terawatts of electricity generation. And you'll notice here, renewables are about 8,500 today. So if we go to the next slide, this is where I feel, so the bias or the message in the media has been, like I say, talking a lot about nuclear. So we said, okay, what is the actual cost of nuclear? This is provided by Lazard. If you see, solar and PV is at the top. The third bar down, you'll notice, well, this is levelized cost of energy table. So solar, just look at those numbers, 24 to 96. And forget about what else COE actually means, but just look at the percentage versus nuclear. So nuclear is down at the bottom, third one from the bottom, 141 to 221. So if you just look at the difference between solar at utility scale, there's a big difference between residential rooftop. It's much more expensive. You see at the very top, it is expensive, 117 to 282. But utility scale solar and geothermal and wind are all almost half of the cost of nuclear. So people that think we're going nuclear and solar is out of the question, it just doesn't make sense. Simple math dictates that not only is renewable cleaner, it's cheaper. So this is why I feel this is a huge setup going into 2025. Whoever's in power, I don't think it's going to matter. Now the thought is Democrats are more favorable to renewables over Republicans. But if you, there's some interesting slides. The districts in the US that benefited the most in Trump's presidency were actually Republican states. Those are the ones that benefited the most by the renewable money spent. And even Donald Trump, he says, drill, baby, drill. He does want to open up the oil and gas sector, but he has said, I'm not opposed to solar. I just want solar manufactured in America. That's when he put the tariffs on solar panels coming from overseas. So if you go, and then you'll see in the International Energy Agency and some of these other sources and publications that are the ones that basically feed into the Paris Accord and all these other mandates we have, there's a lot of planned spending on renewables. and the build out of the grid. This slide is pretty interesting because it shows the terawatt of energy that is to be produced by, we're missing the legend here on the clean. This is basically renewable spending though. So if you look at the increase for 27,500 terawatts today, jumping 3,000 terawatts in just the next, this is basically looking at, the middle of 2022 to 2024. A big jump, and then we'll go down to the next slides. We'll circle back, but to show the nuclear increase is very small compared to that 3,000. Remember that 3,000 terawatt. But yeah, go down a couple more. One more. We'll get to it at the end. But this is, what's that?
You want me to be here on this premium?
Yeah, that one's good.
The PV
We'll
model?
circle back to the
Okay.
This is interesting. So this is a specific company in the solar space. It's called Canadian Solar. This is from their corporate presentation. We wanted to show, so this is the compounding of solar PV module shipments in gigawatts. The gigawatts and terawatts is confusing, but I like this slide. It might take you a few times if you haven't been versed in the power industry, but just look at those growth rates. So this goes back in 2009. 15-year compound annual growth rate in the industry has been 33%. So it's showing gigawatt. Gigawatt is tiny. Remember, there's 1,000 gigawatts in a terawatt. So if we need 3,000 terawatts, it's a huge number. You'll see here some of the growth rates. But let's go back on the right-hand side. If you look at, so based on the Paris Agreement, this is achieving 1.5 degree Celsius reduction in, I believe it's reduction in temperature. But you'll see, look at these years. So just back in 2012, there's only 8 gigawatts installed. 2022 to 2025, 420 gigawatts cumulative annual installations. And look at where you have to get to if you want to reach 5.5 terawatt by 2030. That's an increase from 420 to 2030 is 420 to 5,500. That's 10 times in just what is that, 6 years now. So big, and you'll see again 420 gigawatts or even 5,500 terawatts is not a huge number. So go down, next slide. This is interesting. It shows the number of Fortune 500 companies that have made public climate commitments. So you'll see 331 from 25 from 2015 to 2023, and it shows a bunch of the names at the bottom, from Amazon to Dow Chemical to Meta, which is Facebook. So next,
I think, yeah, and I think as Nick and I, we talk about this a lot, and really trying to understand what the output is now and what it's going to be moving forward for these Fortune 500 companies, Amazon, AWS, Anthropic, ChatGPT, OpenAI. All of these AI infrastructures require an immense amount of energy. And, so we talk a lot about what that growth is going to look like and the energy that's all essentially needed, and who's going to be first to those contracts. Being able to derive and find, those opportunities, something that Nick and I, have certainly spent some time, in the war room discussing. So, what that's going to look like moving forward is going to be interesting.
Mm-hmm. Yeah, and this speaks to the AI. Yeah, which is, it's mind-boggling. Look at what Google search used to use, and this is watt hours per request. It's, it's almost zero compared to, that's almost like an 80x if you think about, 0.1 to 8 for AI powered Google search. So the predictions are that the amount of electricity that's going to be required is the same power to power 40 million homes in the US. So I did a little calculation. You can barely see it underneath, but I just did the math on how many, watts are used. It's basically the average house in the US uses 8,000 kilowatts per year, which is, you see my little number there, 0.008 of a terawatt. So the 0.008 times 40 million equals 320 terawatt. I'm trying to get a picture, right, of, it's confusing, but once you start to dig in and see how much power the world uses, I just want to see, okay, so 320 terawatts is what that equals. Oh, and I said, okay, what does the US consume today as a country? So not just this little 40 million increase. They currently consume 4,000 terawatts per year, according to the EIA, for energy, yeah, it's a national energy association. But so that's interesting. So it's basically a 10%, right? And actually, the math kind of works out, right? Because there's almost 400 million people in the US, so 40 million into 400, 10% increase. But that's just the US, so we've got to think about the world. Okay, so next slide. So this is speaking to our
global green shift.
Marcus, do you want to speak to this? So this is our Mackenzie Global Environmental Fund, which is in a lot of our portfolios.
Absolutely, yeah. So switching gears a little bit to something that we have exposure to in the portfolio to give you a little bit of insight as to how we might be playing this. Mackenzie has a global green chip fund where they're looking for these opportunities all around the world, not just in Canada, not just in the US, but look at Europe and Asia and the exposure there. So it's a really interesting fund with a lot of different exposures to this theme that we've just outlined. We can talk a little bit about how they look at certain companies within their overall portfolio, and it speaks to why in certain cases we choose to use a manager as opposed to go and picking individual names ourselves. This team at Mackenzie, through the Global Green Chip mandate, is specifically their research is all through the green space. And with that, you're able to come up with, companies that they feel that they're able to, invest in for the long term. We take right here, we look at Simmons Energy as in comparison to GE. So Simmons is in their portfolio in the Global Green Chip mandate that we own. GE is not. You look at these two market capitalizations. So we have a $70 billion market capitalization. That's what GE, was trading at the time of this print. And then you look at it in comparison to Simmons, at 30 billion. And when we look at an EBITDA, earnings before interest, tax, and depreciation, you're looking at a very, very similar EBITDA. But yet, Simmons is trading at more than half of its valuation. So not only are, this again goes back to speaking to when we choose to use a manager, within our portfolio, it's because we feel that they're excelling in a specific pocket of the market. In this case, we're talking about the green space, clean energy, and, which circles back to a theme of this call. Nick, did you have anything you wanted to add on that?
Well, yeah, just and these companies actually aren't just green. They do have exposure to other sectors. So it's not like if green doesn't work, they're not going to make money elsewhere. But as you'll see it, especially one of the last slides, it's really eye-opening for the investments that are happening in green. But
yeah, thanks for sure. If you look at here, within the portfolio, they're not just they have quite a wide mandate, and we've even seen oil and gas companies within the mandate that are also through going to a green transition, or ones that are really sticking to that initiative of making the changes that are required to really build out the grid and the infrastructure around clean energy.
Mm. So the next slide, this shows the performance. And this is where we're really excited because look at the year-to-date number. It's only up 7.4%. This fund was up 14% per year net of fees for the last 10 years, but they've had a really lousy. If you look at the dark blue line is the fund on the top. The light blue line at the bottom is the MSCI World. So it's mostly the US, but it's a global index. It really hasn't done much. We're barely above where we were after the big COVID bump, because you think about that time frame, all the energy. So energy, anything that needs a lot of debt, that includes real estate, utilities, power projects, whether it's solar, they don't do well. So during COVID, we had record low interest rates. Remember those that stock market was crazy. That was the best year. I think, yeah, my fund was up 80% that year. It was a really good year for us. But it was yeah, very favorable for this sector. So it's gone sideways basically for 4 years. And if we didn't pull up the solar charts, but Canadian solar specific, the whole sector's down. If you looked at TAN as an ETF you can buy in the US, kind of a funny name, TAN for solar, but it's down, I think 30% year to date. Canadian solar is down 80% from its high. It traded down to $12 per share from the high was around 55 in this COVID, bump. So the narrative has been negative this year. Projects have slowed down, profitability slowed down for these companies. But what we're looking at going forward, we're picking up companies in this sector. Well, you just saw that at the slide previously. The one stock is trading at a 50% discount to one of its peers. So we love it when a sector is out of favor and nobody likes it. The reason we're talking so much about this in this presentation, we think it's the best place to be, not just for this trade off of the elections. So we have the elections, which are going to be very parabolic as to Democrats, good for clean, Republicans, negative. But this is we need this power. And we've shown you some slides. The money is going. So there might be a short-term reaction into, okay, negative if Trump wins, negative solar, negative Tesla. But it's going to come back. It has to. I mean, you just look at these numbers as being. And then on Thursday, we have the Federal Reserve announcement. So interest rates are predicted to come down. So interest rates coming back down, very good for global liquidity, good for utilities, good for real estate, good for small cap. So anyhow, I brought this slide back up again just to quickly show you that number again. Think about that 10,000 terawatt coal. Look at the gas that's generated, 6,500 terawatts, renewables, 4,900. So next slide, nuclear only 2,600. Look at this. I said, okay, that was just electricity generation, right? This is now, if you were to look at the equivalent in terawatts for oil that we use around the world, it is insane. 52,000. If we're only using 25,000 terawatts for power, electricity, we're using 52,000, 2 times the world's electricity in just oil. Then you have coal. So coal, the reason that number is so much larger, I don't know for sure, but I'm guessing, but I'm pretty confident I'm correct. 8,000, if you saw the previous slide was 8,000 coal, that's electricity. Coal is also used for, iron ore smelting and different things. Like we burn coal to do different things around the world. But look at these numbers. If you add up all of these, and even if we only, so think about, okay, oil, okay, we're not going to, stop making plastics, you have to take a lot of this out of the equation. But if we do go from, I think North American electric car usage right now is like 4% of sales. Some countries in Northern Europe are already 80%. China's 20% by the end of next year, I believe. If we convert, 30% of oil demand in the world is from transportation. So 30 times that, 50 is 15,000 terawatts. So just think about these numbers, right? 15,000 terawatts. Even if we only, maybe we don't get, that would assume like 100% transportation went electric, which I think it will. Most people don't believe that. But if you said 30% of 15,000 is like 4,500 terawatt. Okay, so let's go to the next slide. Now that we think about these numbers. This pie graph's a little confusing. Can I take control? Let's see how this works. Can you see my mouse going around, Marcus?
Just gave up control there for you.
Can you see it?
Yep.
Okay. So see these years, 2010, 2020, this is how this pie chart works. So it shows where we were in 2010. So this is just solar, PV, and wind, and then we have electricity consumption, and then electric cars, and then power down here. So now that we understand we're moving, from the inside out. So 374, 2023, we're at 3,900 terawatt, then predicted to be at 18,000. So we can send you these. You see the sources down here. You'll see these later if you want to go back and look at this for your own good and understand it better. But I'm just want to give you the important highlights. So then they're talking about electric vehicles, 2010 being 0, 2023 being 41 million cars, right? Tesla sells 2 million a year right now. So this is globally how many are being sold today. And then going all the way to 481 by 2035. This lines up with a lot of these agreements. We have a lot of countries have mandated, 2030, 2035, all electric. So some people might reverse it. There's talks. We'll see where policy ends up. But anyhow, it just shows you, look at the growth rates. And then natural gas and oil, look at this. So basically flatlining. Little increase. Oil's basically sideways, 87 to 99. It's not really moving here. So the thought is by 2035, we should see peak. Look here. So vehicles will lead a peak in demand for oil, natural gas, and coal by 2030. Though more clean energy, blah, blah, blah. So thinking about, and then coal is actually decreasing, right? Obviously, these are forecasts, but you see the trends here. So we're seeing electricity consumption jumping up a lot because we need a lot more of it. Like if we're going to convert those 55,000 terawatts of oil to electricity, this is where I get really excited at the next. Are we on the Tesla chart yet? Okay, so here is the energy opportunity. Tesla deployed 7 gigawatts last quarter. If you annualize that, that's 30 gigawatts for the year. Elon's talking about getting up to 200 installed capacity with Lathrop in Shanghai. That's almost a 10 times increase. And then he's talking about getting to 1 terawatt, which would be almost 100 times increase in the storage. This is a really big opportunity going forward. We're looking forward to seeing how this unfolds. Thank you for tuning in, everybody. We will end the recording. We will have it available for viewing later. We'll send it out to everybody that participated, and for those that weren't here, we'll send it out to you as well. Happy investing, everybody. Have a good night. Take care.